This is the kickoff to our series that will feature different speakers covering key industry topics each month in an informal setting to allow for open QA and those networking opportunities that we've already talked about. Our first topic today is catastrophe risk management credentialization. And before I pass this over to our speaker, I am just going to snag another quick moment to review the designations in the process for those that may not be familiar. So recognizing that the cat risk management profession has become increasingly important to the insurance industry, and that knowledge, processes, and practices are evolving and have changed significantly over the last 30 years. The ISCM has collaborated with iCAS to offer 2 designations based on experience. These are the first independent and comprehensive credentials in the marketplace. So the 2 levels. First is Tier 1. Tier 1 is the Certified Specialist in Catastrophe Risk, CSCR. And that designation ensures that an analyst has working knowledge of catastrophe analytics along with certain core competencies. There are 2 pathways for this designation. The exam pathway includes 4 exams with some available waivers if you have certifications through the CPCU or LMA and completion of an online ethics module. There's also an experienced industry professional pathway available for a limited time for those that have 5 years or more experience. Nomination can be by someone who has the Certified Catastrophe Risk Management Professional, CCRMP designation, or a current or past manager. Tier 2 is that CCRMP designation, and that offers an advanced certification for those who have moved or desire to move into more senior catastrophe management roles. Currently, the only pathway for this certification is through the Experienced Industry Professional Pathway, and that's available by nomination by someone who already has this designation. Similar to other industry credentials, those awarded either of the designations will need to be members of both the ISCM and iCAS, though membership provides a lot of great opportunities, even apart from these credentials, to be part of that professional community with access to continuing education activities, forums, industry events, et cetera, that will help foster continued advancement within the community. So now to introduce our speaker, Andrew Golub is the first person to complete the CSCR designation through the exam pathway. And he's here to talk about his experience taking the exams and why he took the exams. Andrew is a managing director and the chief analytics officer at Beecher Carlson and has roughly 14 years of work experience in the risk analytics field. He currently focuses on the development and implementation of tools that assist large corporate clients in more effectively quantifying, managing, and financing their exposure to property and liability perils. So welcome, Andrew.
Thanks, Megan. So I have a couple of things I want to talk about today. I want to share my experience going through the exams for this credential. I want to talk a little bit about my motivation for doing the credential studying. I also want to talk about, as an employer, some of the benefits I see that an employee could bring to bear if they have a credential like this for CAT modeling. To kick it off, I want to give a little bit of insight into the type of work I do and have done throughout my career. Insurance distribution or insurance intermediaries as a type of company seems a bit arcane, but it's really not. If you think about what insurance does in the economy, basically you have the real world, right? You have firms out there providing goods and services to individuals and other companies, manufacturing, retail, technology, what have you. And those organizations need protection for volatility that could occur through property damage to the assets they own, or liability against them for lawsuits filed against them, et cetera. And they need protection from that volatility so that they can plan, budget, grow, and add value to the overall society that we live in. So you got those types of organizations paying premium into the insurance system, and then you have on the other end of the value chain risk-bearing capital that's provided by reinsurance companies, capital markets, etc. In between those two things, you have insurance companies, and you have a link between those insurance companies and the organizations in the real economy, and that link is the insurance distribution sector. So I've worked at two different types of organizations within insurance distribution. The first one I worked at is what's called an MGA, or a managing general agency. That's an interesting type of entity, but basically working at one of those is very similar to working at an insurance company. So before, Megan talked about working at Sampo, which is an insurance company that writes property casualty risk. Working at an MGA is similar. The only difference is that the MGA itself does not bear financial underwriting risk, right? So an insurance company or some other risk-bearing entity will, give permission or underwriting authority to an MGA to select risks on their behalf, price risks on their behalf, and also to manage an overall portfolio of exposures on their behalf. So an MGA is technically an insurance intermediary, but working there from a career path standpoint is not that different to working at an insurance company. So from a CAT modeling perspective, the type of analysis you do working at an MGA involves pricing. It could involve rate making. It involves managing the overall portfolio to make sure that the aggregate exposure you have to a single event or multiple events, like a hurricane or multiple earthquakes, is not outside of your carrier partner's ability to absorb that or their appetite to do so. So an MGA is a very similar setting to an insurance company. Retail brokerage is where I transitioned to about 4 years into my career, and that's a pretty different setting. Retail brokerage is where the interface of the insurance industry and the real economy meets. So organizations such as myself and our competitors go out and partner with our clients, who are entities that buy coverage, and help them to effectively negotiate that risk transfer with insurance organizations around the globe, and also to design the programs so that they're absorbing the amount of risk that they're comfortable with and it's optimal for them. So think about the decision-making process you go through when you're buying a homeowner's policy or a car insurance policy, right? You got to determine how much limit you need, and you got to determine how high the deductible can be before it gets outside your comfort zone, right? So if it's auto insurance for physical damage, you really in the US don't have an obligation to buy coverage. But if you don't buy coverage and you crash your car, you're not going to have a car that functions anymore. If the insurance is there, you'll only be out of pocket for the deductible. So the level of that deductible matters, because if it's too high and you can't pay for it, it could be financially devastating. That decision-making process is very similar for the types of large companies I work with. The only difference is that they have a lot more funds than individuals do. So rather than thinking about, should I have a $500 deductible or a $1,000 deductible on my property policy, they might be thinking, should I have a $5 million per occurrence deductible or a $20 million per occurrence deductible? Which one's a better fit for me? Obviously, the premium associated with the policy that attaches above a $20 million deductible is going to be less, right? So there's a risk-reward trade-off, and CAT modeling and all sorts of analytics can help our clients to make more informed decisions about how to best navigate those waters. That's my background. My motivation for pursuing this credential was that, I already had an actuarial fellowship in the quantitative finance area, done a bunch of master's degrees, statistics, actuarial science, et cetera. So I've been involved with continuing education and formal academic education for a long time and throughout my career. And I've also been involved with throughout my career with catastrophe modeling. So when this credential came up, it piqued my interest. I wanted to get a better set of insights into the underpinnings of how the numbers are generated. I already knew how to interpret a probability distribution in a catastrophe model setting, but I didn't have a firm grip on how the assumptions that drove the definition or the articulation of that probability distribution was formulated. So this credential program looked like a really well-structured, well-designed, succinct, easily accessible set of readings, and that got me excited about pursuing it. My experience was very positive. I enjoyed the content involved. I found the exam difficulty to be reasonable. It was something I had to study for, but it wasn't something that crushed my personal life necessarily from a time management standpoint. And overall, it was very enjoyable. Some of the topics covered were review to me from previous things I had learned either through osmosis on the job or through other studies. For example, I knew a lot of the basics of actuarial rate making, reserving, capital management for insurance companies. So that was a refresher. It was a welcome refresher because it was viewed through the lens of catastrophe modeling, which provided somewhat of a fresh perspective on material I was already comfortable with, but it was a review. However, other topics covered on within the program were pretty new to me. I didn't have a strong physical science background, even though I did have a good background in mathematics and statistics. So things like how storms form in the North Atlantic Basin, how storms dissipate in terms of power when they make landfall, and how that's modeled were new concepts to me. And I think having a structured set of readings that introduce those got me to look into them in a way that I might not have done had I just been, engaging upon my own, course of study through my personal interests. So as an employee, that's what, got me excited about doing the coursework. As an employer, the things that would get me excited if a prospective hire had done the coursework are a couple things. One, they've gone through and established a core level of competency on these topics. That doesn't necessarily mean that they're an expert in all the things involved, but it means that they have at least a fundamental underpinning that they can build upon probably more quickly once they get on the job than would otherwise be the case if they were starting from scratch. The other things that it would signal to me as a potential employer of candidates is that this individual who has gone through this process has made a commitment to the insurance industry in general and to the catastrophe modeling subspecialty within the insurance industry more specifically, right? That's a positive thing. That's something that someone has done in their free time. It's going to make them more effective at their job in all likelihood, and which they didn't have to do, right? Furthermore, it's something that they have done that signals that they're willing to put in additional work on themselves, and oftentimes that translates to successful performance on the job. So that's my experience, and that's my current view of the program. I think it's a really positive thing, and I hope that some of you look into pursuing it. So with that, I'll pass it back to Megan. Thank you very much.
Thank you, Andrew. And we did have one quick question come through the chat that I wanted to address. You do not need to be a CAS fellow to register for the certification. There is no requirement there.